This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
This is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to discuss holiday sales as retailers prepare for a little less cheer this year.
Plus, why beverage producers are set to raise capital spending in 2023.
But first, we have the recession versus inflation debate. And nowhere can you see that played out most successfully when it comes to multinational industrials. They are really going to be tested, whether we're looking at peak inflation or whether you're looking at another downturn. For more, we're joined by Bloomberg Intelligence industrials analyst Mustafa Okur. Mustafa, what are industrial companies right now preparing for when it comes to the fourth quarter and 2023?
Basically, industrial companies in the U.S. have been on a bit of a tailwind following the post-pandemic recovery. They've built up massive backlogs. Pricing has been strong. Volumes are coming back. But given the macroeconomic sentiment, the direction that the interest rates are heading, we're getting a lot of questions from our clients about what happens in a potential recession or a downturn. What happens if industrial production begins to contract? Where can we hide? Now, we can't really answer that question directly at Bloomberg, but we decided to do a study, and we wanted to do two things. We wanted to identify which companies would perform better relative to others in our sector, and secondly, which companies could perform better or worse relative to their own history. So we started with a straightforward historical regression study. We took our 40-odd companies, divided them into two groups. Group one is the diversified multi-industrials of the world. You have Honeywell, ITW, big companies, and small companies as well. But their common trait is they're well diversified in terms of end markets. And our second group, you have our machinery companies, which tend to be more cyclical. We ran this regression study against industrial production, and we found two things. First one is that the multi-industrials, as expected, they're less sensitive to industrial production in the U.S. Their sensitivity ranges from 0.3 to 2.4. So for every 1 point move in IP, their sales moves about 2.5 points at most. And then on the machinery side, that metric, that sensitivity, goes from 2 to 5. So much more cyclical, much more volatile, which is sort of expected. And where things get really interesting is when we started layering in on using our own expertise about what happened to some of these multis, how their portfolios have changed, and how this regression may not tell the whole story.
Give us some names here. What are some of the names that maybe screen a little bit better versus ones that maybe don't screen so well?
So on the multi side, you have companies that are screening well, such as ITW, Honeywell that I've mentioned before. That is expected, right? And they've stayed well diversified over the years. Towards the higher end of the multis, or towards the more cyclical side, you have companies like Eaton and Dover, for example, which we know have actually transformed their portfolios by going on a bit of a diet. So Eaton, for example, sold their lighting business. They've sold their hydraulics business. So rather than, moving by about 2 times IP, we expect them to move a little bit less if there's a recession. So they're less exposed than before.
Mm-hmm. I also wonder, when we talk about diversification, do we need to talk about it in terms of the products they offer being diversified or their end user base being diversified?
It's both, really. But the end user is a little bit more important, because I'll give you the example of a company that we cover called Amphenol. The products themselves, they don't really range that much. So they're connectors, sensors, antenna. But their end markets are very, very diverse, right? They sell to automotive, data center, mobile network companies. So that helps shield their sales compared to a company that sells many, many products, but let's say their main end market is limited to 1 or 2 cyclical end markets like automotive, let's say.
Talk to us about the balance sheet quality of the industrial sector today. How is that looking coming into what might be, a recession?
I would say the balance sheet looks they look a lot better than the prior recessions. A good leverage metric, net debt to EBITDA for industrial companies is about 2.5 times. Some of them go up to like 3.5 times to do deals. But I would say, for the most part, the sector is really well placed. And the other thing is, last time we had a big recession before the pandemic, the 2008 and 9, great financial crisis. That was a liquidity crisis. Yeah. What we're heading into now, into 2023, we don't expect that kind of liquidity crunch. At the same time, we have massive backlogs, so a lot of the future sales are already in the backlog. So unless we have a deep recession and the backlogs evaporate, we don't really expect a big hit on the balance sheet.
Before we wrap it up, we talked a lot about the recession part and the demand part. Where are these guys in mitigating inflationary pressures? Have they peaked for them yet?
Inflation coming from raw materials, like steel, for example, they've begun to peak. The hedges are rolling over, so they're going to get more and more of a benefit going into Q4 and Q1. At the same time, they've implemented a lot of price raises. So a lot of the companies that we cover, they have actually become price-cost neutral, at least on the raw material side. The challenges are coming more from the labor side for some companies, as well as some specific parts. So castings in aerospace, for example, have been an issue. Some resins have been in short supply. And electronic chips, I have to say, that continues to be volatile supply for these guys as well.
All right, Mustafa, we really appreciate it. Thank you so much. Bloomberg Intelligence Industrials Analyst Mustafa Okur.
Coming up on the program, how Jefferies Investment Bank is utilizing senior talent to fuel growth.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, a push for more senior talent at Jefferies is fueling the investment bank's growth, and it's likely that the streak of hiring and promoting will continue for some time. To get some more on this, we're joined by Bloomberg Intelligence Bank's analyst, Neil Sipes. So, Neil, I've been following this Jefferies story, really solid mid-tier investment bank historically. But they've been aggressively hiring, trying to, I guess, grow that business, haven't they?
Yeah, exactly. And that's really kind of Jefferies' core strategy. And when we think about Jefferies in the context of some of its larger peers, they're much more focused on those investment banking fees. So think advisory and underwriting. And so that's really kind of the much more capital light businesses, the more fee generating businesses, rather than the balance sheet and capital intensive trading. And so this is where Jefferies thinks they can win against some of those larger competitors, given their balance sheet size disadvantage. And when you look at their investment banking fees, they're expected to be about double 2019 levels, which we use as kind of a pre-pandemic pace. Whereas you look at some of these larger competitors and they're going to be back towards the 2019 level this year. And all of that has really been driven by that significant managing director headcount growth.
I thought that investment banking was going to take a big old pause.
Yes, and unfortunately for Jefferies' strategy, it has this year. But let's remember that we are coming off of a record 2021, especially for equity fees as well as M&A. And, we were expecting a fairly strong year heading into 2022. Of course, later on, shortly thereafter, from the start of, sort of the geopolitical tensions later in February, we obviously saw quite a bit of activity come off the table. The pipelines are now kind of stalled out, and activity is sort of waiting on the sidelines for a little bit more clarity from the Fed, from inflation, and from kind of the economic outlook as a whole.
So, Neil, when you talk about hiring investment bankers away, which I love, by the way, I love that whole poaching strategy, worked for me very well for many years, you got to pay up. So talk to us about the compensation ratio at Jefferies, maybe versus some of its peers.
Yeah, sure. And I think it also helps, again, to look back at 2021, where there was this kind of record level of activity in the investment bank. Everyone across the street was hiring very aggressively. You saw many headlines of kind of the junior and more senior ranks seeing pretty significant increases in their salaries. that was during a record year. This year is a very tough year for investment banking. And so we do expect that to kind of come back as a little bit of a pressure. What we've seen so far this year is that banks have been able to kind of manage their compensation expenses down with revenue. Comp is an accrual, so it's accruing throughout the year of the expectation of the full year. And so over the next few weeks and the next few months, we're definitely going to be keeping an eye on any sort of headlines and anything we hear from the banks in terms of year-end bonuses, which you can kind of get a gauge of by looking at sort of industry activity, which is down about 40% this year.
Also, if there was to be the leverage for investment bankers at Jefferies, like where would they jump ship to? Because other investment banks are going to have the same problem. You'd usually go to private equity or hedge funds, right? But at least in the private equity world, that's going to become a tougher and tougher environment too.
Right. And so, I think Jefferies has been very successful in kind of the opportunistic hiring. Look, everyone, even non-financial firms, they want to be hiring from within, or rather promoting from within. But Jefferies has been very opportunistic in hiring where there's been challenges at some of their competitors. And obviously, financial services are very broad. There are many competitors across the globe. Some of the ones that we've been able to kind of pinpoint as being sources of talent for Jefferies are Credit Suisse, are Deutsche Bank. So you look at 2019, Deutsche Bank shrinking their equities unit. Jefferies was able to capitalize on that, pick up some of that talent, which kind of meshes with their strategy. And of course, more recently with Credit Suisse, the challenges they've faced after missteps and now a shrinking of their investment bank. There's been help from that in recent months and potentially more going forward.
What's a typical transaction size for Jefferies?
So again, I think as you alluded to, they're a little bit of the middle market investment bank. So it is going to be, I guess, on average, smaller than what you see at, call it a JP Morgan or a Goldman Sachs. And that's, again, really kind of where they're focusing in on. Whereas, yes, these larger investment banks do have exposure in that middle market space, but Jefferies is more heavily focused there, so they can kind of provide that sort of competitive advantage. And within that middle market space, it's interesting. That's where you'll see a lot of financial sponsors transacting, those private equity firms. These are very attractive clients for Jefferies and for their competitors as well, because they're very much more recurring kind of clients. They're constantly transacting. They're constantly fundraising, deploying that capital. So that's kind of a target focus for Jefferies.
So you make a good point about the big guys trying to also get some in the middle market, but Jefferies just is still so entrenched. Who are then Jefferies' pure competitors at this point?
I would put their pure competitors at perhaps some of those boutique investment banks where you look at Evercore, Lazard. But again, we're talking about JP Morgan and Goldman Sachs and Citigroups and all of that alike. And I think what's notable for Jefferies is, perhaps they've been flying under that radar for a little bit, but when you kind of stack them up where their core business is really that advisory business, that M&A advisory business, they actually rank larger than Citigroup now by fees. Consensus expects them to exceed Bank of America this year. So really kind of gaining that prowess in that space.
One of the businesses that you hear from the larger diversified investment banks that they really like is the private wealth management business. It's low capital, steady fee business. Is Jefferies in that at all?
No, so they are not. So they're, again, really focused solely on that investment banking business, both the fees as well as the trading. I think, look, there's obviously benefits to having that larger wealth platform. You see the successes at Morgan Stanley, at UBS. You see that's kind of the piece and the portion that Credit Suisse is really focused on keeping and growing while shrinking that investment bank, which again, we see that as an opportunity for Jefferies going forward. But I think Jefferies is really focused in doing what it does well, and not necessarily trying to be everything for everyone. Which
is so tempting for these guys to always go into wealth management. I feel like everyone, like Goldman trying to do that too. I feel it really ramped that up. It's a tempting feel. Before we let you go, how are they dealing with expenses? How are they managing expenses right now?
Yeah, so I guess as I noted earlier, the biggest, most variable cost that we can look at in this kind of environment is that compensation expense. So the cost for talent. So we've seen revenue come down about 30 or 35% so far this year. You've seen compensation expense come down similarly. So they're managing that expense well, which is fairly notable considering how much talent that they've hired over the past few years, which can obviously put upward pressure on that comp ratio. But being able to manage that in a period where activity is not so great is incredibly important. And to be able to retain that talent going forward, because eventually capital markets will open back up, and you got to have that workforce. You got to have that talent to serve your clients.
All right, good stuff, Neil. Really appreciate it. That's Neil Sipes, Bloomberg Intelligence banks analyst.
All right, coming up on the program, how underinvestment in oil and gas now risks global energy security.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. It's 25 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies in 130 industries worldwide.
Let's turn to one of my favorite topics, and that is energy. So, improving global energy security was the primary focus of the 2022 Abu Dhabi International Petroleum Exhibition Conference. Industry leaders there really emphasized the uptick in underinvestment in the space. So, I want to welcome now Bloomberg Intelligence senior energy analyst Will Hares. Will, when I say energy security, am I talking about the ability to secure my energy, or am I talking about making sure my pipelines don't blow up?
You're mostly talking about the ability to access affordable energy for a country's population. So that was exactly what the major theme coming out of this conference was, is that there's a lot of risk in the future for accessing sufficient supply to prevent spiraling prices, driving cost of living issues now in many countries around the world.
So, Will, I know particularly over there in Europe, you guys are really experiencing some challenges on the energy front. Give us a sense of kind of how the industry, how investors, maybe how governments are thinking about kind of the balance between greening up this economy and this energy infrastructure with the fact that, boy, we need oil and gas now.
Absolutely. So emissions reduction objectives and climate policy risk absolutely featured far more in the background at this conference than in prior years. And I think it's a really good reflection of that sentiment. The immediate need right now is to access more oil and more gas. And there was a noticeable view from many industry leaders here that policymakers and public sentiment had driven an energy transition that was accelerated too fast and too far to undermine energy security for the European region, but also more broadly.
So, I mean, this sounds like it makes sense, but does that mean that companies are like, oh, okay, I'm going to go spend a lot more money and drill more?
So here's a really interesting point, is that the underinvestment as a result of these issues was also a key theme. However, while we agree that these companies are mostly investing far less than they did, say, pre-pandemic, there's actually embedded incentives for these companies to maintain that capital discipline. We are seeing investors demand returns. We're seeing a lot of free cash flow being deployed into dividends, into buybacks, and very, very restrained spending across the sector, from shale E&Ps in the U.S. to the oil majors. So we expect that despite President Biden asking for these companies to invest more, we expect continued capital discipline. Unfortunately, this is not really an immediate solution to the problems being faced with energy security.
Is it a question, Will, of maybe rethinking, government incentives and just rethinking energy policy to maybe strike a better balance where, in fact, you can have political parties supporting fossil fuels while, also maintaining longer-term goals on, greenhouse emissions and things like that?
Well, unfortunately, it's actually going in the opposite direction for several countries, including my own in the UK, where the government has just passed a windfall tax and is actually looking at increasing the windfall tax strictly on UK North Sea producers, which unanimously has been sort of decried as a major disincentive to increase supply. So you raise a very good point in that supportive policy is needed, but also it's ramming up against the sort of political realities and the desire from the wider public sentiment to reduce emissions over the long term. And I have to say that the vibe that I got from this conference contrasts very sharply with some of the headlines that we are seeing coming out of COP27 right now in Egypt, which really underscores how difficult this threading of the needle will be between energy security and sustainability over the mid to long term.
And I feel like a place where this meets is with LNG in Europe, for example. So buyers in Europe want to secure like 7-year contracts. So it is, in that essence, this is a short-term bridge to more alternative fuels. But if I'm an exporter, I'm not going to spend $20 billion for 7 years. I'm going to spend $20 billion if you give me a 20-year contract. Are these details where we're going to find the nuances of energy security?
Yes, absolutely. So LNG has been absolutely critical for European energy security and displacing some of the Russian supply that was roughly 40% of demand. We're going to see continued more LNG coming into the continent. We've already seen record cargoes landed this year. We expect it to be 60% higher amount of LNG coming in 2023, but still it won't be enough to fully offset the loss of Russian supply. We know that Nord Stream 1 is not coming back now indefinitely. The Yamal pipeline is offline. There's a couple smaller pipelines that Russia is operating, but it's a very small amount. And so the flex is going to have to be demand. Demand is going to have to flex by 15 to possibly 20%. And Europe is by no means out of the woods, even though we have very high storage right now. Next winter is going to be the real question, given the almost full loss of Russian supply all through next year.
Yeah, we saw the NG, for example, said that their customers are like 30% demand destruction already. So like it's already rippling through in some respects. Hey, Will, thanks a lot, Will Hares, Bloomberg Intelligence senior energy analyst. Always good to chat with you.
Coming up on the program, holiday sales are promising less cheer for retailers this year.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Naturally, it is time for us to start talking about holiday sales. And to do that, Bloomberg Intelligence senior retail analyst Jen Bartashus joins us now. All right, Jennifer, what are we expecting in terms of holiday sales? We've already seen some warnings here from Amazon, looking at cost-cutting measures, maybe not going to hire as many seasonal workers. Give me the broad strokes here.
Well, if you look at the industry as a whole, sales this year are going to go up, but that's mostly due to higher prices. And it's going to be the weakest holiday season that we've seen in several years.
All right. So, I mean, we've got inflation out there for the consumer. We've got a lot of recession talk out there for people to have to deal with. Is that kind of just the headwinds that I'm going to maybe pull back a little bit on my holiday shopping?
I think people are still keen to celebrate, but they're going to be very selective in how they do it. You know, in terms of spending patterns, there are some bright spots for this holiday season. Luxury is actually going to perform very well because we're seeing a bifurcation of that consumer where the people who have money are still going to be spending. People who have less money are going to be a lot more careful about where they're spending. And then there are certain parts of the economy where we're going to see some stronger sales. So athleisure is one category where we think things will be pretty good. Gaming consoles is another. Beauty is a third, but then there will be other areas like apparel that will really be pressured this year.
That's true. I will pay anything for my face lotion from Skin Cuticles, but like forget any other clothes. If it's not on sale, I'm not buying it. Are we going to be buying in-store or online? And did Amazon's signals mean something for the broader industry, or was that a specific Amazon problem?
Well, when you look at Amazon, you know, I think that partly it's an Amazon problem, but it is also a reflection of the greater industry. We actually took a look at Bloomberg second measured transaction data from credit cards, and we looked at the period of October up until the last week of October. And what we saw was that spending was up only 5.7%. And that's during a time when Amazon had their Prime Day sale, and Amazon was included in the companies that we tracked. And so it seems that the efforts by retailers to really attract spending early, they got some of that traction, but it really wasn't as much as maybe they thought it would be. And so for Amazon, I think that there are certainly some issues that they're dealing with, but I think they're also looking at that broader environment, and they're not getting as much traction as they thought, and that showed through when we saw their results recently.
So, Jen, let's talk about like supply chain and inventory. If I go actually to a store and want to buy something, is it going to be on the shelf?
For the most part, there will be things on the shelves. Some retailers were able to sort of change their purchase orders early on so that they didn't end up with too much inventory. But it depends really on what become hot categories. Across the board, there should be enough inventory, but the real risk this year is that there are going to be much, much higher discounts. And while that's good for the shopper, that's actually bad for the retailers and bad for their margins. And the more inventory they have, the higher those discounts are going to go, and the more pressure we're going to see on margins as we look at the fourth quarter in its entirety.
Okay, I'm going to be your channel checks for this because I only shop on sales, and I haven't seen them hit yet. I'm waiting, and I'm not seeing them hit full force. Where am I going to see them
Black
hit?
Friday.
Yeah, believe me. I say to my family, I'm like, guys, I'm hunkering down for a couple of hours. No one talk to me. So where am I going to be doing that shopping? Like, which areas are too over-inventoried at this point?
The areas that are too over-inventoried, it's really in apparel. And so
like across the board, like no distinction between like luxury and Kohl's versus example?
Luxury, there's higher demand, and so they probably have inventory sized a little bit right based on demand. But a company like Kohl's or Macy's or even Nordstrom to a certain degree, they haven't got those inventory levels right yet. And so we've already seen in October discounts in the 30% range, sometimes 40% range. And that's the type of level that we think we're going to see as we get to Black Friday and between Black Friday and then Christmas itself. And that's a much higher discount level than we've seen in years past.
Okay.
Hey, Jen, has the death of the bricks and mortar store, has that been kind of debunked? Or it kind of feels like people are going back to stores.
People are going back to stores, Paul, and it's really part of the balancing act, because people like to go to stores for inspiration. It's still not easy to just browse and find interesting things online without having a starting point. And stores can really fill that function. And so what we're seeing is that people will go into stores, they look around, they shop around, but a lot of times now they'll be on their phone in the store, price comparisons. And so they get those ideas. So stores are still important. People will still go there. And don't forget, with the holiday season, people who tend to procrastinate in gift giving end up in stores because at some point shipping becomes a gamble and whether gifts will arrive on time. So that's where the stores get to shine as we get closer to the actual holiday.
Paul, the death of brick and mortar reminds me of the death of linear TV that we've been talking about for like 20 years.
Right, exactly.
It just can't die. Hey, Jen, thanks a lot. Really appreciate it. Jennifer Bartashus joining us. She's Bloomberg Intelligence, a senior retail analyst.
All right, now let's turn to the beverage industry where a raise in capital spending could be on tap for 2023. We get more on this from Bloomberg Intelligence senior beverage, tobacco, and cannabis analyst Ken Shea. So, Ken, I think about a recession scenario. Everybody's running the recession scenarios. What do your beverage companies do in terms of recessions, and what do they do with their spending? How are you looking forward to 2023?
Yeah, so, with the third quarter round of earnings releases out, companies, I think, surprise people a little bit with their confidence going into 23. We all read about, the so-called recession around the corner and, people are going to be tightening their belts and trading down. Well, that's not really the collective thought, at least that I took away from the big beverage companies. And so I ran some numbers, and it looks like collectively we're looking at a high single-digit increase in capital spending next year. And it kind of runs the gamut of what they're going to invest in. First of all, we're looking at big brand promotion investments. World Cup starts in a couple weeks. Companies are not going to be shy about reminding consumers who were locked in the house in the pandemic last few years that they're still relevant and they're still out there. And so the Coca-Colas and the AB InBevs of the world are going to be investing heavily in World Cup. They're also going to be building out on things they learned during the pandemic that make a lot of sense in their business. The B2B business, that's an electronic delivery between businesses and the manufacturer. More digitalization, marketing, direct-to-consumer initiatives where they can. They're going to continue to build on. And then finally, investing in good old manufacturing capacity, particularly the brewers, AB InBev, Heineken, Constellation Brands. They all have plans to build more brick and mortar to make more beer. And that's all positive news for investors.
Now, is that kind of CapEx spend and OpEx spend need to be as long as their demand holds up and they have pricing power? Because what also surprised me so much on their analyst calls was how much of these guys think they have so much pricing power and what the runway is for that.
Well, I think these companies thinking long term. Sure, they could be overshooting and maybe demand isn't there, but these are companies that have been through recessions and ups and downs of the market for many years, and they have brands that they believe are going to be around for a long time. And so they're going to continue to invest in them. And also it includes some, short-term fads or short-term demand items like cocktails in a can. And there's still some life, I think, left in the hard seltzer business with new flavors. But at the same time, a consistent theme we've heard over the last few years, and it's going to be another theme for next year, will be the premium product investments. Premium bourbons, tequilas are still red hot, and I think you're going to see a lot more additional products in that space.
Hey, Ken, when I think about your big consumer companies, the beverage companies like ABN, InBev, and Constellation Brands and Coca-Cola, I think really steady cash flows there, and that's allowed them to return cash to shareholders. Are they saying they're going to do anything different in 2023 if, in fact, this recession becomes an issue?
Well, that's a good question. So what are they going to do with all this money? Well, the note that we put out the other day was that their capital allocation plans still call for share buybacks and dividends. You got to remember this. These companies have been around a long time. Yep. A big investor base likes the dividends, and they're committed to them. And so we would expect that's going to remain a high priority. But again, the company is make sure there's enough in there to invest for the future on the things that I just mentioned. Share buybacks are going to be opportunistic. And all those things I just mentioned, I think are going to have a higher priority than M&A. Strangely, you would think, well, this confidence, make some more acquisitions. I think they're going to kind of cool to that in 23. And I think because there still is some lingering uncertainty about the economy in Europe, some uncertainties with what's going on out there. And so I think they're going to be a little more cautious with M&A in 23. I don't think that's going to be highest of priorities.
Before we let you go, what are some of the companies that are best positioned and worst positioned?
Well, I think companies with the strongest balance sheets, because I'm talking in general terms here. I'm not talking in all companies, but I would look for the Constellation Brands, the Brown-Formans, the Monster Beverage. These are companies that have PepsiCo, very strong balance sheets, and are going to remain opportunistic for any kind of investment. All the ones that I mentioned, they're going to be looking for.
What's the valuation of your group right now, Ken? Or do you feel like it's fairly valued by the marketplace?
I was just running those numbers. They trade about a 10% premium to the overall market, and that's kind of where they've always been. It gravitates up a little, up and down a little bit, but never straying too far, because I think most long-term investors see these as just long-term plays. I think the economics in this group, I think, are superior to that of other consumer goods areas. And I think if you just hold on to these long enough, the economic returns will translate, I think, to above average capital appreciation.
All right, Ken, always a pleasure. Ken Shea, Bloomberg Intelligence Senior Beverage and Tobacco Cannabis Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 57 minutes past the hour, and this is Bloomberg.